Okay, let's get started. Good morning. I posted midterm 2 on Blackboard already, so in case you haven't checked it, go check it online. And I know many of you want to take a look at the exam. So this Wednesday I'll be distributing the exam and we'll go over each and every question together, okay, to see if you have questions on the problems. I want to make sure that you all understand all the concepts I tested you on midterm. But right now I know the average is about 65. Okay, it isn't really well, but actually many of the problems I gave you is based on homework and based on quick check section and multiple choice questions. Okay, but that's all right. We still have final. Right, final actually counts for 40%. And this Wednesday I also want to go over some of the adjustments I want to make on final to help you guys progress and excel on final. Right, I want to adjust some of the chapters. I may not make it from 1 to 14. All right, I'm going to cut off some of the chapters. Okay, so today I want to continue Chapter 11. We have 2 more sections, and we'll leave all the questions on midterms till Wednesday. Okay, Wednesday in class. And if you're urgent, you have other questions, see me after class. Okay? Now, Chapter 11, we went over long-term liabilities. Last week we talked about long-term notes payable. We talked about mortgages. Bonds payable is another category of long-term notes. It's basically groups of long-term notes. So bonds is a way for companies to raise money from the public, not on a one-on-one situation, but one-to-many. Okay, so earlier last week, the examples we went over in class is either a corporation borrowing money from the bank or from other institutions at full, a huge amount of dollar amounts, lending money from a bank from financial institutions. So bonds payable is another way for corporations to loan money from multiple bondholders from the public. Okay, so meaning right now it's not just the bank, not just the company, but from individuals, from the public. So typically bonds, their face value is at a smaller dollar amount. It's usually at $1,000. Okay, so meaning that instead of borrowing $100,000 altogether from another financial institution, they can break down this loaning money dollar amount to loan it from individuals, from the public, at $1,000, $2,000, $3,000. Okay, so if we look at altogether the total amount of loan money, it could be a lot more than simply signing off a long-term notes payable between other financial institutions. So in the investor's perspective, what do they gain? They loan money to a corporation. What do they gain? Interest, right? Interest for bonds is a little different from long-term notes and mortgages. So interest, if an investor borrows money to the corporation, they typically receive interest every half a year. So every 6 months, they receive 6 months of interest. Another 6 months, 6 months of interest. So it's usually not by an annual basis, or not all together at once until the bond matures, but every half a year, investors receive semi-annual interest amount. Okay, so when the bond is due, after 5 years, 10 years, that's the time when the face value is paid back to the investor from the corporation. Okay, so for bonds, the differences between this and regular long-term notes and mortgages is that usually interests are given semi-annually, and also this is a one-to-many situation instead of signing off a long-term promissory note to one specific institution. You can lend money from multiple lenders from the public. So bond is also traded in bonds exchange market. It's traded in primary markets, secondary markets. So it could be investors' perspective. They can resell it back to the market. Pay back all the way until the lifetime ends for the bond, the maturity date. Okay, later on we'll go over some of the examples. Okay, so this is a general idea of what is bond. The same characteristics between this and long-term notes, mortgages. They're all long-term debts that due more than a year. That's a longer time period. Okay, now there are different categories of bonds. Of course, this is not the entire set of categories. There are many more than this. Okay, but the chapter introduced different types of bonds specifically based on the characteristics of its time period and also whether it's backed up by assets or not. Okay, so the first 2 categories, term bonds, serial bonds. The differences between those two is whether the full amount is paid little by little every single year or altogether when a bond is due. So for all the problems you see in this chapter, basically we're talking about term bonds. Okay, term bonds, meaning that the maturity value, if the corporate issues $1,000 bond, at the end, after 5 years, they pay back the full amount after 5 years, $1,000. The serial bonds, they may break this 1,000 into 200, 200, 200. So just like the concept of long-term notes payable, paying by installments we covered last week, serial bonds, investors may receive a portion of the maturity value and the interest every year. Okay, so the first two categories are based upon whether the maturity value is received all together at the end or breaking it down to a portion, investors receiving it little by little. Third and fourth, these are the types of bonds, whether they're the characteristics here, the differences between these two is whether the bond is backed up by assets or not. So this concept here is exactly the same as mortgages. They may have mortgage-secured bonds, meaning that these bonds, if the corporation failed to pay interest or principal amount on time, the investors has the right to receive the title of the assets backed under this type of bond. Okay, so secured bonds, they're backed up by assets. Debentures, as opposed to secure bonds, they're not backed up by assets. When investors purchase it, it's based on the credit rating of the bond. If the defaults, they're not receiving any assets, but simply the value of the debenture of this type of bond. Okay, so the first two categories based on its time period when the investors receive the full amount, the maturity value. Second and the third, just the categories of bonds, whether they are backed up by assets or not. So notice that this is not the entire set of the categories of bonds, and also these are not mutually exclusive, meaning that the bond could be a term bond, with maturity value due at the end, at the same time backed up by assets. Okay, so these are not mutually exclusive. They could have some of the characteristics of different types of categories of bonds. Now, if we take a look at in more detail, how do we account for the price of the bond? You have a question? Debentures are not backed up by assets as opposed to secured bonds. Okay, meaning that if a corporate doesn't fail to pay the principal amount, the interest, none of the title of other assets transfers to investors as opposed to secured bonds. Okay. Now, if we take a look at more details, how do we account for bond prices? So this is quite different from long-term notes and mortgages in a sense that sometimes companies can issue bonds exactly at the amount of its face value. So usually when they issue bond, if they have $1,000 in mind, they issue this $1,000 maturity value of bond, they may be exactly receiving $1,000 at par at maturity value, or they may be receiving a little bit lower than that at discount, or higher than that at a premium. So these three categories are all possible. They may all occur based upon comparing interest rates. Okay, so when companies issue the bond, they have a set interest rate in mind. They may offer investors, let's say, 10% of the interest. However, whether they're actually receiving, for example, $1,000 depends upon whether the market interest rate is also 10%. So market interest rate represents the investor's expectation of the interest they're receiving. If the company is not able to offer the same interest rate as the market expectation, they will only be receiving a dollar amount lower than the face value, issuing the bond at a discount. On the other hand, if they're issuing the bond at a higher interest rate, exceeding the market interest rate, then they're able to issue the bond at a premium, meaning they can actually receive slightly more than the face value. Okay, so let's take a look at these three examples. Assuming that this company wants to raise $1,000, okay? Remember, issuing bonds, usually it's more than $1,000, but issuing bond, the purpose is to finance their operations, right? They have more funding to expand their different departments, different research projects, or development plans. So if they have $1,000 in mind, and currently the market interest rate is 10%, when we say issue at par, meaning issue at the maturity value, that means this bond price right now, the company, when they issue this $1,000, they can actually receive exactly $1,000. Consider upon they are offering the same interest rate as the market. Okay, so this is what we call issuing the bond at maturity value. Company has $1,000 in mind. They give out a bond certificate, they're actually receiving $1,000 from investors if these two rates equal to each other. Okay, meaning the market's expectation is 10%, my company is also willing to give out 10% interest rate of bonds. This is the first case. So this specific day, by the issuance date, a corporation is receiving $1,000, they're loaning money from the public, and the investors is the bond holder. Later on, by the end of the fifth year, they're receiving this $1,000 back. In the middle, every half a year, they're receiving 10% of interest multiplied 6/12. Right? Remember, interest rate when we calculate it, it's always based on maturity value, $1,000, multiply interest rate 10%, multiply time period, 6/12. So every half a year, they will be receiving $50 of interest for 5 years. Okay, so this is the first case, issuing the bond at maturity value, meaning corporation has $1,000 in mind, and since they're offering the interest rate exactly the same as market interest rate, they will be receiving $1,000 from the investor. Now the second case, assuming again the corporation is raising $1,000, market interest rate again is 10%. But right now, if my company's financial condition is not as well, I'm only able to give out 8% of interest. This case here, the market will not be able to actually lend money to the corporation at $1,000, but at a dollar amount slightly lower than the face value. Because if this investor purchased another company's bond, they may have an interest rate 10%, they'll be receiving more. So at the issuance date, the issue price will not be $1,000, but it will be some price lower than the face value. So assuming that it's $980. So meaning this very day when the corporation issued the bond, they're not receiving $1,000, they're only receiving $980. However, after 5 years, regardless of the issue price they receive, they will still be paying back $1,000 because this is the bond's maturity value, it's the stated value, the face value. Okay, so the point that I want to make is the issue price may not be the same as the maturity value. This depends on the current status of the interest rate a corporation is offering and the market interest rate. These two, if the market interest rate is higher than our corporation's interest rate, we will not be receiving a dollar amount at the face value. It will be lower than that. This is what we call issuing the bond at a discount. Okay, we're not actually, corporation's perspective, we're not actually receiving $1,000. It's lower than that because our interest rate is not as attractive as other companies. Okay, so this is the second case, issuing the bond at a discount. At the end, regardless of issuing that premium, at par, at discounts, they're all $1,000. So this is the amount stated on bond certificate. Right, this is the amount of bond's face value. At the end of the day, we're always paying back the face value. In the beginning, they're getting $1,000 if the two interest rate matches. Right? So this is the $1,000 that they're paying back to investor. Remember, this chapter is on. $1,000 is the face value they receive at the end, but in between they're receiving $50 of interest every half a year. Okay, so this is the additional part that they're receiving based on lending money to the corporation. Okay, so in the investor's perspective, they're receiving the interest rate. They're gaining the interest rate. No, the $1,000 is the face value of the bond. Okay, so the face value of the bond is $1,000. There's a specific day this is issued. The two parties, the corporation, whoever is receiving it. And their stated interest rate right now, assuming is 10%, it matches with the market interest rate. At the end, that means the beginning, the issue price. Investors are loaning money to my company, $1,000. At the end, I'm paying it back to investor $1,000. but in between, I'm also giving interest $50 every half a year. Okay? So this is the first case. Second case, if the two interest rates are not the same, my company's interest rate is only 8% less attractive compared to market interest rate, their expectation. So in this case here, even though I'm still issuing a $1,000 bond, I will not be able to receive $1,000 because this is issued at a discount, because other companies have a higher interest rate. And if this investor invests in this company, they will usually purchase the bond at a discount. It's not received, not issued in full. So in the corporation's perspective, they're not receiving $1,000, but some dollar amount lower than $1,000. It could be $960, $980, depends on the current status of the market and the price agreed between the two parties. Okay, so this is the second case, issuing the bond at a discount if my company's interest rate is lower than market interest rate. Third case here, issuing at a premium. Assuming that our company is issuing the bond, again, $1,000. They want to raise $1,000. However, their interest rate is slightly more than the market interest rate. So this rarely happens because company also wants to earn money. But if they stated the interest rate before, and nowadays, later on, the market interest rate decreased, this case here, they will be able to raise a dollar amount that is slightly above the face value, because the interest rate they're offering compared to other companies is more attractive than other companies. So this case here is not a discount, but rather a premium. They're able to raise the money that is higher than the bond certificate's dollar amount. The middle part's still the same. Every half a year, they're paying back to investors $50. This part doesn't change regardless of the issue price. Okay, because interest rate is always calculated based on face value of the bond, face value of long-term notes, face value of mortgages. Okay, so interest rate for all three cases is $50 every half a year. Maturity value for all three cases at the end, corporation is paying back to investors $1,000 after 5 years. What's different is the issue price. The starting point of the bond, whether the corporation is receiving $1,000 or not, depends on their interest rate and the market's interest rate. This is the only difference for all three cases. Okay, so going back to here, stated in the slide here really is the same example as I covered here. So for bonds, corporations can issue it at par if their interest rate is the same as market interest rate. They're actually receiving $1,000. They can issue it at discount, meaning if they really need the money, they really need to fund their projects, expand their operations, they may still be willing to issue the bond even if it's at a discount. They will still receive a certain funding even though it's lower than the face value. So this is the case when their interest rate is not as attractive compared to market interest rate. At a premium, their interest rate offered is higher than the market's expectation, and they may receive a dollar amount that is above the face value. Okay, but again, regardless of the price, regardless of the issue price, the price that corporation is borrowing from the public, at the end of the day, when the bond is due, they're still paying back simply just the face value, $1,000. Okay, so the difference is just the bond price, the issue price. Whether or not corporation is receiving that $1,000 depends on the two interest rates. Okay, if we take a look at the interest rate again, if they're the same percentages, then the corporation will be able to receive the money based on the face value of the bond. If the interest rate of the corporation, the stated interest rate represents the company's interest rate, what they're trying to offer to investor. If this is lower than the market's expectation, then they're not able to receive the face value but only at a discount price. Third case here, if the stated interest rate company is offering more than the market, then they will be able to raise the money above the face value at a premium. Okay, now if we take a look at bond exchange market, the price stated for the bond usually is not exactly $1,000, $2,000, but it's at a price quoted, the percentages of the dollar. Okay, so meaning that if you take a look at Wall Street's website, Wall Street News website, you see the bond price at $100. that means the corporation actually issued the bond at its 100% of the face value, $1,000, if we go back to our example earlier. If it's issued at 101.5, that means they raised $1,015, basically. So 101.5% of the face value. If the quoted price is 89.75, that means it's 89.75 percentages of the face value. So the price of the bond usually is not exactly listed as the dollar amount, but rather the quoted price, percentages of the price. Okay, so think of the term as 100%, 101.5%, 89.75% of the price of the face value. Okay, let's take a look at an example. So bond prices, we talked about earlier, the different examples, they're determined based on market interest rate, company's interest rate they're offering to investors, and also the face value of the bond. Okay, and the time they issue it, of course, the timing, that means they want to compare the time they issue whether the market interest rate exceeds their company's interest rate or not. That's the timing issue. So let's say the market interest rate is 6%. This company issues bonds payable with a stated interest rate, meaning they want to offer 5.75%. This case here, letter A, this case here, are we issuing the bond if you're the company? Will you be able to issue it at par, at discount, or at premium? At discount, right? Because the stated interest rate, what we're trying to offer, is lower than the market value. We will not be able to raise the money, for example, again, not $1,000, but perhaps $960, $980, depends on the two parties, but it will always be lower than the face value. Second case, if you're issuing the bond 8% and the market interest rate is 7.25. So this will be a premium, right? Because our company's interest rate is more attractive compared to other companies. So it will be a premium. We may issue it at a dollar amount above $1,000. What about the third case? If we issue 7% bond and the market interest rate is exactly 7%. And maturity value at par, right? Exactly $1,000. We have this in mind. We're actually receiving $1,000. Okay, so these are the three cases that may all happen in the bond exchange market. Now let's take a look at the price, how we interpret this. So remember that think of this as percentages of the price. So what is actually the issue price for 500,000 issued at 76.75? So trying to calculate the issue price here for ABC. Okay, so here we're just looking at bond prices, so you can disregard that 7% for now. Okay, so ABC, what it means, A, if you look at the price is 76.75, that means it's already a discounted price. The corporation is not receiving at 100% of the face value. So if you multiply, remember that is the percentages of the price. So think of it as 0.7675. This is exactly the issue price, is the money that the corporation is receiving from investors based on this trading transaction. Okay, they're issuing at a discount, meaning that it must have been the 7% is lower than the market price. So their issue price, they're not able to receive $500,000, even though this is the face value. They'll be receiving lower than that. Second case, again, percentages, so you multiply 1.0475. We're issuing the bond at a premium, meaning our interest rate, 7%, is higher than market interest rate. Okay, so at the end, we'll be able to receive a dollar amount above the face value. So what about the third case? Is it a discount or a premium? $95.75 is actually a discount. Any dollar amount lower than 100, that means we're not actually raising 500,000, but only 478,750. Okay, so these prices may vary, but it tells you something that if you issue it at 76, if you issue it at discount, that means your 7% interest rate is not attractive to investors. They could purchase the bonds from other companies, but if they purchase it with your company, then they'll be giving you a discount price, not giving you the face value. Second case, your interest rate is more attractive compared to market interest rate. So we'll be receiving the dollar amount above the face value. Third case, again, is a discount case. You can say, in an investor's perspective, you will want to purchase a bond at the discount price now, because that's lower than the face value, and later on you'll be receiving the face value. Okay? But the corporation's perspective depends on how urgent they want to use the money. They can either wait till later when the market rate changes to match with their market interest rate, or if they're really urgent, they will still issue a bond to raise the capital. Okay. Okay, now we talked about the face value, the prices, different cases. Now we're going to go into more details on how do we actually journalize all this. And so we talked about the price, especially for any type of long-term liabilities or short-term liabilities. Remember, the key entries always is what is the issuance entry? What is the interest entry in the middle? And then when it comes to the end of the lifetime of the debt or the assets, how do we journalize paying back the money to investor? Okay, so it's always the issuance entry, always the interest entry, and at the end, how do we pay back the money? Three main sets of entries. But for bonds, it's a little different because we have the case of discounts, we have the case of premiums. We have to do something about discounts and premiums. Okay, because at the end, we're still paying $1,000. But at the beginning, we journalize the entry perhaps at discounts $980, perhaps at premium $1,100. So that $20 difference, that $1,100 difference, we have to do something about those discounts and premiums. What we're doing in accounting is we're going to spread it along the years. So just like how we spread along the cost of assets, remember depreciation, we allocate along the years. For bond discount differences, premium differences, we also allocate it along the years. Okay, so let's take a look at the case that is simpler. If we issue it exactly at the par value, meaning we don't have to worry about premiums or discounts here. So the first entry, assuming that the company is issuing a $100,000 bond, and the bond, our stated interest rate is 9%. We're willing to give out investors 9% of interest. It's a 5-year bond. So this first entry here represents collecting money from investors, issuing bond certificate. So we debit cash, credit bonds payable at its face value. The reason why we're debiting and crediting at its face value is because this is the case for issuing at par. Meaning we already matched the interest rates between our stated interest rate and the market. If they agree with each other, then we will actually be able to receive $100,000 here. So this first entry is the issuance entry. And when it comes to half a year later, remember every 6 months we're giving back a little bit of interest back to investor. This is how a bond works. So half a year later, interest expense, we directly pay by cash, right? Because here is actually cash payment of interest. It's not the end of the year adjustments. So we're actually paying cash interest here. Cash interest is always calculated. The interest expense, again, the same formula, just like short-term notes, long-term notes. It's always calculated based on maturity value, the face value, the interest rate, time period. Okay, so this part, this interest rate, will always be using we'll always be using stated interest rate, company's interest rate. The only time when the market interest rate factors in is the issue price, the first entry. Remember earlier we talked about when we decide the issue price, it's based upon comparing these two interest rates. After you issue the bond, later on, all the journal entries is based upon face value and stated interest rate, company's interest rate. Okay, so market interest rate really just factors in the first entry, whether we have a discount or a premium or not. So this is a case again for par. If we issue it exactly at bond's face value, $100,000. First journal entry, receiving cash, giving out bonds payable. This is a liability from the corporation to investor. Second journal entry, after half a year, we're paying interest. So principal amount, stated interest rate, half a year, 6/12. So after another 6 months, December 31st, we're journalizing exactly the same entry here. Debit interest expense, credit cash. So this entry will appear 10 times because this bond has a 5-year lifetime. Every half a year, we journalize interest expense, credit cash entry. Now, what happens after 5 years? Reverse the first entry, exactly. So the last entry here, debit bonds payable, we're actually paying back this loan money from investor back to them. Right, so the first entry is issuing the bonds, collecting cash, loaning money from others. Second entry is giving out interest every half a year. This third entry, after 5 years, when it comes to the end of the bond's lifetime, we're always paying back the face value, $100,000. Okay, so this entry will work for all 3 situations. If we issue it at premium, issue it at discounts, at the end, we're always paying back the face value, $100,000. Okay, so again, 3 main entries. The issuance entry and bond at par, $100,000, directly as its face value. Second entry, when we pay back interest a little bit every half a year, we journalize this entry for 10 times because this bond has a 5-year lifetime. So every half a year, 5 multiple 2, 10 times in this interest payment entry. After 5 years, we're paying back this face value to investors. So we reduce this bonds payable by debiting bonds payable, crediting cash. Okay, let's work on an example. Let's say our company issued a $110,000 bond, and the stated interest rate, meaning the interest rate that we're offering to investors, is 6.5%. So assuming this interest rate is the same as the market interest rate, therefore we're issuing the bond at par. First entry, how do we journalize the issuance? And if you could, try to journalize interest expense and also paying back the bond. 3 entries. Okay, the first entry here, if we're issuing the bond payable, we're collecting money from investors. So this first entry will be debiting cash, crediting bonds payable at the face value, because this is the case of issuing the bond at par, at its face value, $110,000. Okay, so after this entry, when it comes to June 30th, when it comes to December 31st, we're giving back half a year of the interest back to investors on a semi-annual basis. So this dollar amount will be calculated based on face value multiplied 6.5% and 6/12. Okay, so the second entry appears every half a year until the bond matures. Debit interest expense, credit cash. Okay, now after 15 years, after journalizing this entry for 30 times, when it comes to the end of the lifetime, when bond matures, we're paying back the dollar amount in full, the face value, maturity value in full, back to investors. The $110,000 will be debiting bonds payable, reducing the liability, and crediting cash, actually paying back the principal amount to investors. Okay, any questions on this problem? Or let's take a look at a discount case. So when we issue the bond at a discount, the first issuance entry will look like this. So assuming that we're issuing a $100,000 bond, again, this is the face value, maturity value of the bond. Now, if my company's interest rate is lower than market interest rate, not as attractive, so in this case, as we mentioned earlier, the issue price would not exactly be $100,000, but it will be a dollar amount lower than that. Okay, so let's say the issue price is $96.149. So that means we're only collecting about 96% of the face value. So the actual cash we're receiving here is $96,149. And remember, bonds payable is always recorded at its face value, because at the end we're paying this face value back to investor. Even though the cash we collected now is not the same amount, we're still paying back $100,000 later. Okay, so the differences between these two we accounted under an account contra liability account called discount on bonds payable. Okay, so this account holds the differences between issue price and the maturity value, the differences between those two. This is what we call discounts on bonds payable. Because earlier when we issue it at par, the journal entry would just be debit cash, credit bonds payable, no differences in between. Now if we're issuing a bond at a discount, remember the market interest rate is higher. In this case, when we journalize this entry, we'll be debiting cash, crediting bonds payable, and debiting the differences between those two dollar amounts. Interest is always based on face value, $100,000. Okay? But later on we'll talk about how do we account for the differences between these two numbers. So we have to do something about discounts because later on we'll be paying back the face value of $100,000. And that discount account is to be reduced little by little. We spread it along the years. And so if we post these information to the T accounts, omitting cash for now, we just look at bonds payable and the liability account, the contra account, discount on bonds payable. We have a credit balance, which represents the face value of the bond, $100,000. We have a debit balance, discount on bonds, holding the differences, $3,851. So these two accounts, just like depreciation, we have historical cost of the asset and the accumulated depreciation. For bonds, this discount lowers down the value of the bond, so we can see the carrying amount. So you can think of this as book value. The carrying amount of the bond is $96,149. Okay, so meaning the carrying amount at the day of the issuance, this is the exact amount company is collecting from investors. This is still the bond's face value, and this holds the differences between the two. Okay, so this first entry is the issuance entry, collecting cash, issuing bonds, also recording any differences between issue price and the face value. Okay, so if we take a look at, if we represent these informations on a statement, usually the contra account, any type of contra account is always listed underneath the main account. Okay, so long-term liability section of balance sheet, we have bonds payable, original face value, and we also have the discount amount. And this represents the dollar amount company actually collects. The differences, so we're going to talk about this. So this differences, we're going to spread it along the years. Okay, so this difference is really in accounting, we recognize this as additional interest given to investors. Okay, we recognize those differences, 3,851, as additional interest given to investors. So if we really think about it, our company wants to raise $100,000, but we only got about $96,000. You can think of it as giving additional $4,000 of interest to investor in order to receive this $96,000. Okay, so this is how we're going to account for this differences, 3,851. We'll be spreading along every half a year's interest entry to take care of these and gradually reduce this discount account. Okay, so let's take a look at the entries better to understand this. Again, when it comes to half a year later, when we want to calculate the interest, the cash interest part is always calculated based on principal amount, interest rates, time period. Okay, so just like the previous entry, we have $4,500 of cash interest paid to investor. But what's different here is that discount that we talked about earlier, the $3,000, we spread it along the lifetime of the bond, divided by 5 years. And since this is a half a year entry, divided by another 2, 6 over 12, we consider this $385 together with the cash interest we're paying as additional interest expense paid to investor. Okay, because we haven't received the $100,000, we only received about $96,000. Those differences, we think of it as additional expense, interest expense already paid to investor in order for us to receive that $96,000. So every half a year when we're journalizing interest entry, we spread a little bit of this discount together to represent it under interest expense. Okay, so what we're doing here, discount on bonds payable. This is the full amount of the discount. We divide it by 5 years, divided by 2, because this is a half a year interest entry. Right, so every half a year we'll be journalizing this exact same entry, debiting interest expense, crediting not just only cash, but also a part of the discount. We recognize this as additional interest expense to investor, but we already paid to them. So now we're just spreading the cost along. Okay, so every half a year you will see this entry, debit interest expense, credit cash. This is the actual cash payment of interest we're giving to investors, $4,500. But this $385, we think of it as additional interest that we already paid to investor at issuance, since we collected less amount of money. So these two together are considered interest expense. So meaning that every half a year when we journalize this interest entry, we will reduce this discount on bonds payable, $385, reduce it by $385, another $385. So when it comes to the end of the lifetime, after 5 years, if you take a look at the T accounts, bonds payable is always there, $100,000, but the discount account is no longer $3,000 something. When it comes to the end, it actually disappears. That entire discount account that we talked about earlier, this part here, every half a year we reduce it by $385, $385, $385. And when it comes to the end of a bond's lifetime, this account disappears. We're just paying back $100,000 to investors. Okay, so the purpose of spreading that discount is really to bring up bonds carrying amount up to $100,000, because at the end we're paying $100,000. Okay, so in accounting, we take care of this by spreading this discount. Consider this as additional interest expense. Every half a year, we journalize them together with cash interest payments. Okay, now when it comes to the end of the bond's lifetime, again, we're just paying $100,000 because this every half a year reduces. So that discount contra account basically disappears at the end. We're just paying back the full amount, $100,000 at the end. Okay, we'll take a look at these entries from the beginning. When we issue the bond, we're collecting cash not at $100,000, but at a value lower than face value. We're issuing bonds payable. This is always recorded at its face value. This holds the discounts between the issue price, the differences between issue price and the bond's face value. We call it discount on bonds payable. This is a contra account to bonds payable because it's represented under bonds face value to show the carrying amount of the bond. Okay, so what we're trying to do later on is bring back this carrying amount back to $100,000. And to do this, we recognize this discount as additional interest expense already given to investors at the beginning when we signed this note, when we signed the bond. We already give away the difference is about $4,000, and later we're just going to spread it along the interest expense entry. So when we journalize every half a year interest expense, we'll be debiting interest expense, crediting cash plus discounts. So we allocate this discounts just like depreciation. We allocate it along the lifetime of the asset. Here we allocate it along the lifetime of the bond. So think of the discount as the differences, the amount of interest we already pay to investors at the issuance time point. So now we're recognizing it together under interest expense. Okay, the third entry, when we collect the full amount of money, when we're paying back the full amount of money, we debit bonds payable, credit cash. So this entry will always be the same across all three situations. Okay, let's work on an example. Let's say this company issued $40,000 bond to face value, and the interest rate is 5%. This is a 10-year bond issued at 90. Okay, so we have three main entries again. How do we journalize issuance entry, interest expense, and then how do we pay back the money to investors? Okay, if we take a look at this example, say the bond's face value is $40,000. Okay, so this is the beginning maturity value the corporate has in mind to raise $40,000. However, the market interest rate is higher than our corporate's interest rate, and later we're only able to receive 90% of the face value. So meaning that the first entry here, we're only collecting 90% of the face value, $36,000. This is the cash related to this bonds payable we're issuing, the cash amount that we're actually receiving. We're issuing bonds payable always, this is recorded at its face value, $40,000, because this is a dollar amount that we're paying back to investors, regardless of the price we're actually collecting here. Okay, so bonds face value is always recorded at, bonds always recorded at its face value, $40,000. So the differences, that 10% differences, is what we call discounts on bonds payable, $4,000. Okay, so we think of this differences, this $4,000 as additional interest that we already paid to investor. We think of it this way because we haven't actually collected $40,000. We only collected $36,000. We think of it as additional $4,000 interest that we readily pay to investor in order to receive this $36,000. So later on, when we're journalizing interest expense based on $40,000, multiply 5%, multiply 6 over 12, we're also taking care of this discount, spreading along the years. Every half a year, we record $200 of discount. Consider it together as interest. Okay, so this is how we take care of this discount on bonds payable. We think of this as additional interest paid to investor in order for us to raise money from them. So the next entry, when we journalize interest, cash part is always related to the face value of the bond, stated interest rate, time period. This is the actual cash amount of interest we're paying to investor. Here we're also allocating discounts along the years. Every half a year we record $200 together with the cash interest as interest expense recorded. Okay, so when we issue the bond at a discount, cash interest no longer matches with actual interest expense we're recording because we're also allocating the discounts, which is the part we think of the interest as already given to investors in the beginning of issuance. So every half a year we journalize this exact same entry, record cash payment $1,000, allocate part of discounts, and then together they're considered interest expense. Okay, so originally we have a discount $4,000. Every half a year we reduce $200. The bond payable part was, how much? Bond was $40,000. So originally, when we issued the bond, it was $40,000 face value, discount is $4,000, carrying amount was $36,000. This is the carrying amount at the day of issuance. Later on, every half a year, we reduce discounts on bonds payable, $200. After 10 years, this account would reach zero. And this bonds payable, we will only see $30,000 on balance sheet. And that will be the exact amount we're paying back to investors later. Okay, so we're just taking care of this discount by spreading along this cost. Think of it as additional interest that we receive from investors. At the end, when the bond matures, we're debiting bonds payable, crediting cash exactly at its face value, $40,000. Okay, so for discounts, for premium, the really key point is the interest entry. How do we allocate this cost along the years? We need to divide it by the lifetime of the bond and the time period, which is half a year. Okay, so all the problems we see for bonds, issuance of the entry is always given, issuance of the interest is always given every half a year. Okay, any questions so far? Now let's take a look at the premium case. So the logic is very similar. It's just that we're moving discounts on the debit side into credit side premium, because this is the opposite. We're now receiving lower amount of cash, but actually exceeding the face value. So the first example here, the first issuance entry, let's say we issue the bond $100,000, but our interest rate is more attractive to investors. It's higher than the market interest rate. We receive a dollar amount at $104,000, $104,100. Okay, so this dollar amount, this is the cash amount we're receiving. Again, bonds payable is always recorded at its face value. The difference is that exceeds the face value is considered a premium on bonds payable. Okay, so this is the issuance entry. If we take a look at the T accounts, again, bonds payable, we open it up, credit it at its face value. The other account, premium, is not a contra account because we don't reduce it from bonds payable, but rather we support it to bonds payable account. It has the same direction. Okay, meaning that these two together forms the carrying amount of bonds at this dollar amount. So this premium, we separate it from bonds payable. It's not called a contra account, we call it an adjunct account, meaning it has the same direction as its main account. Contra account, the definition, has the opposite direction, right? Allowances, accumulated depreciation, they're all contra accounts. This pretty much is the only adjunct account you will see in this entire course. Okay, so this premium on bonds payable, the direction is also the credit balance, credit normal balance. It supports bonds payable. If you add them up, this together is the bonds carrying amount. So just like how we take care of discounts, we also allocate premium. Okay, so we think of this premium as readily received interest reserves, meaning that even though later on we're giving investors at an interest rate 9%, it's higher than the market interest rate. This part we think of it as interest reserve, which reduces our interest expense. So it's the opposite of issuing bond at a discount. Discount, we think of it as additional interest paid to investor. This premium here is the opposite. It seems like we already paid off a portion of the interest to investors. So later on, this interest, this premium, when we allocate it, it reduces interest expense. So let's take a look at the entry for interest. If we look at the balance sheet, we still have bonds payable at its face value. And the premium accounts, notice that again, it's an adjunct account, so we add it to the balance of the face value of bond. So we need to allocate that $4,100, again, along the lifetime of the bond. So little by little, every half a year when we journalize interest, we also spread a little bit of premium. Our goal, again, is later on to match bond's face value, carrying value to $100,000. Okay, so the interest entry here, this interest entry, again, we debit interest expense, we credit cash. These two accounts will never change. Okay, if it's at par, there's only two accounts. If it's a discount, we credit discount. Here's the case of premium. We allocate this premium account since it has a credit balance. We allocate it by debiting this account. Okay, so this cash interest here, again, is calculated by face value, interest rate, time period. This would always be $4,500, the cash we're actually paying to investor. The difference is whether we're allocating discount or premium. Discount is considered additional interest expense to investors. Premium is sort of like interest reserve. So this reduces interest expense, meaning that we receive additional money from investors at the time point when we issue the bond. Later on, we'll record interest expense at a lower level. It seems like we already received additional money, additional interest from them. So even though we're paying $4,500, we don't record this entirely as interest expense. But reducing premium, whatever is remaining is considered interest expense. Okay, so premium on bonds payable, the entire dollar amount, we spread it along 5 years, and then every half a year when we journalize this interest expense, reduce premium by $410. So every half a year reduces $410, $410, $410. So even though originally the carrying amount was above $100,000, when it comes to the end, when the bond dues, the bond carrying amount reaches again $100,000 at its face value. So we're just trying to take care of this discount and premium by allocating along the years because the maturity value doesn't match with issue price. So we need to do something about the differences in accounting. We consider it either as discounts additional interest expense, or this reduces interest as an interest reserve. So later, when it comes to the end of the bond's lifetime, we're again paying back just by the face value, because right now the carrying amount of the bond already reaches $100,000 after we spread along the cost. Okay, let's work on an example. So this company issued $50,000, 5% bond, 10-year lifetime, and at a price 108. Okay, so again, try to journalize the issuance entry. What is the interest spread along every half a year? Okay, what is the issue price for this problem? What is the money that a company is actually receiving from an investor? $50,000 is the face value of the bond, but now we're receiving a price at 108, right? So 108, that means our cash receipt is actually $54,000 after multiplying 1.08. So we're issuing the bond at a premium exceeding the face value. The difference is here is where we consider a premium on bonds payable. Okay, if this exceeds, the cash we're receiving exceeds the face value, it's a premium. If it's lower than face value, it's a discount. Okay, so we talked about the discount case earlier. Here's a case of premium. So then later on, when it comes to every half a year issuing the interest, giving out the interest back to investors, we're always using the bonds payable face value to calculate cash interest. Okay, so $50,000 multiply 5%, it's a yearly interest rate, multiply 6 over 12, half a year. That's the cash interest part. We're also allocating premium on bonds payable. So we think of this as reducing our interest expense because we collected additional money from investors earlier. So this reduces the money we're receiving, we're actually recording for interest expense. We spread it along the interest entry by dividing it by its lifetime, 10 years, and then multiplying 6 over 12. Okay, so this next entry here, interest giving out interest entry. Again, our cash interest part is really the part that we're paying to investor, the $1,250. So face value, stated interest rate, time period. Premium, we recognize this as reducing our interest expense because we already collected an excessive amount of money earlier from investors. Okay, so this premium total amount divided by the lifetime of the bond divided by half a year, 6 over 12. These two, using the cash amount of interest we're paying, subtracting 200 premium we're allocating, becomes the interest expense we're actually recording. Okay, so every half a year we journalize this entry until the bond matures. So again, when the bond matures, we're paying back not the issue price we collected, but only $100,000, the face value of the bond. So the third entry will be debit bonds payable, credit cash $50,000, the face value. Okay, so for all these cases, for bonds, when we issue it at par, remember when our company's interest rate matches with market interest rate. Cash collection will be the face value. If we go back to our example earlier, $1,000. Later on, we're also paying back $1,000. Issuing the bond at premium, meaning we're collecting excessive amount of money earlier since our interest rate is more attractive to investors. Later on, we're still paying back just the face value. If we issue it at discount, that means our interest rate not as attractive to investors, so we'll discount the price giving to our company when we issue the bonds to them. So that price we're receiving, the issue price, will be lower than the face value. But at the end, we're still paying back the face value of the bond back to investor. So the key entry here is really the interest part is very important. Right? The interest part, when we allocate a premium, allocate a discount, we spread it along the years. So discount is considered additional interest that we give to investors in order to receive the bond. Premium, seems like we received additional amount of money. We actually receive additional amount of money compared to our face value. We spread it along the years. This reduces our interest. Okay, so for all three cases, what we talked about earlier, just have one last slide to go over. What we talked about earlier was the case when we issue the bond in the beginning of the year. We give out interest June 30th. We give out interest December 31st. In some cases, we may also need to do adjustments for interest. So just like earlier when we talked about short-term notes, long-term notes, if it carries on to second accounting period. So for bond, it's the same case. If we didn't issue it in January 1st, some of the companies may issue it in March 1st, October 1st, different time points. And when you give out the interest, it may not actually match with the ending time point of accounting period. So this case here, if we issue the bond on October 1st, theoretically, we'd only need to give out interest March 31st, right, after half a year. But when it comes to the cutoff point for this accounting period, December 31st, we need to adjust the interest as interest payable. Okay, so this is the only account that's different between this and the examples we went over earlier. Earlier we talked about directly paying cash. Here, we're just adjusting the part as payable. This is a liability, accrued liabilities that we need to pay later on back to investors. So this first entry here, we're just recording 3 months of interest payable. It's not the actual pay date yet, not 6 months, only 3 months of interest payable. Discount, whenever we journalize an interest entry, we also need to take care of the discount allocation or the premium allocation. So this discount here is also for 3 months only. Later on, when it actually comes to the actual date for interest payment, of course we have an interest payable that we recorded earlier at the end of last year. We need to reverse that account. And then the remaining accounts is exactly the same as regular cash payment entry. Okay, so here we're still paying interest 6 months altogether, just like previously, the slide that we showed. Discounts here, since we took care of 3 months of discount already, we just have 3 months left. Right, the interest payable, we're just reversing what we did earlier. And then this is the interest expense part altogether. Okay, so the first entry here we're doing is reporting just okay, give me one more minute and we can all go away. Interest expense here, we just have 3 months of interest to record at year end, and then after that adjustment entry, we need to reverse this entry by debiting interest payable. So all the accounts here is the same. We're just trying to accrue the interest here. If the case for issuing bonds, it's not from the beginning of the year, but somewhere in the middle.